In this chapter, we will look at job order costing and process costing. We will take a look specifically at job order costing and look at how we account for all of these custom products. Job order costing is used to assign costs to each particular job. A job is set up when a customer would call and request an item to be made. These are used for custom design jobs. For example, we can look at either a guitar manufacturer or maybe a designer wedding dress or things like a boat where somebody wouldn't be able to just go and buy these items. They're made once the order has been placed. We compare this to process costing, which is a way to assign costs to homogeneous products such as paper products, toilet paper, or any product really that you can buy at your local convenience store. Ketchup, aluminum foil, things that are going to be sitting on a shelf because they have constant demand. We will talk about process costing in more detail in another chapter. Now let's take a closer look at our three product costs. We'll start with materials. As you know, materials is an asset and will increase with a debit, decrease with a credit. Therefore, when we purchase materials, we would increase our materials inventory and also increase our accounts payable or however we purchase that item. Our next product cost is our factory labor or our direct labor. When we look at our direct labor, employees usually have to punch time tickets or they have some other specific way of recording how much time is charged to each particular job. And finally, let's take a look at our actual factory overhead. I want you to notice the word actual. These are actual expenses that we are having that go to our jobs. But remember, factory overhead is all of those indirect costs that we can't trace directly to each particular job. So these are things such as your utilities expense, your indirect materials such as grease going into the work or nails and screws. We are also looking at our depreciation. To understand how we account for costs in any particular costing system, we need to understand the flow of the manufacturing costs. Products will start as raw materials. We store these in our materials inventory. Once a job has been started, these materials get moved to work in process. The direct labor and factory overhead are also added to the job here. Once these products are finished, they would move to our finished goods inventory. These are all assets on our balance sheet. Once an item is sold, we then move it to our cost of goods sold, and it will show up in our income statement as an expense. Now, once materials are requested for a job, this is when the materials get sent to our work in process account. Work in process is an asset account because that's where our inventory is held until it is sold or sent to finished goods. So when materials are requested to go to a job, we would debit our work in process and credit our materials. This lowers the amount of materials available in our inventory. This journal entry will show you how we record direct labor to a job. First, we would debit our work in process account, and then we would credit our wages payable. That debit to work in process shows that work has been done to this job, and these costs are being assigned to this particular job. You notice that work in process is an asset account, and this account will sit in our assets on our balance sheet until it is recorded in our cost of goods sold. There will be no expenses recorded for wages. Now the problem comes in when we have actual factory overhead. These expenses might not be coming in until later when these jobs are done. Typically, what we want to do is assign costs to jobs immediately so that we can find an amount to charge our customers. In order to do so, what we need to do is figure out our applied factory overhead. So what we will do is apply an amount of overhead to each job based on our predetermined overhead rate. In order to find our predetermined overhead rate, we would take our estimated total factory overhead cost and divide that by our estimated activity. In order to remember this equation, I would remember that it is estimated over estimated. Both of these numbers are estimated amounts. An example of this, in looking at this guitar company, is if we took our total overhead cost and divided by our activity base. Your activity base is just whatever drives that overhead cost. It could be direct labor hours, it could be machine hours, it could be material used. It's whatever they tell you in that problem is driving that overhead cost. Here in this example, it's direct labor hours. So we would take that 50,000 and divide it by 10,000. So for each job, we would charge $5 per direct labor hour to our overhead cost. Then once we have our predetermined factory overhead rate, we would look at each job and see how many direct labor hours they have, because that is our activity base in this example. And we would charge $5 per direct labor hour into our factory overhead account for each job. And that's how we would apply our factory overhead to the job. Now, because we just determined our applied factory overhead, applied means this is what is going into the job. Therefore, we would debit our work in process so that we can assign factory overhead cost to this particular job, and we will credit our factory overhead. So you can note that your factory overhead is credited for applied overhead. Your factory overhead would be a debit for actual overhead. And we'll look into this a little bit more in the next slide. Typically, at the end of the year, what we will do is look at our actual overhead versus our applied overhead. Remember, our actual overhead has a debit balance. Our applied overhead has a credit balance. When we look at our overhead account, we will notice if we have a debit balance, we have under-applied our overhead. If we have a credit balance, that means we have over-applied our overhead, and this will need to be adjusted at the end of the year. Now, at the end of the year, we will adjust our factory overhead account in order to close it out. It will have a zero balance if our debits equal our credits, and that's our goal. So we want to make sure that we close our account to cost of goods sold, because in actuality, our work in process account is going into our cost of goods sold to show the expenses that are related to each job. Therefore, if our factory overhead applied is not accurate, our cost of goods sold is not accurate. And since this goes to our income statement, we need to make sure that our cost of goods sold is accurate at the end of the year. Therefore, if we have under-applied factory overhead, we would debit our cost of goods sold, increasing our expenses. Or if we have over-applied our factory overhead, or it charged too much to our cost of goods sold, we would then have to lower the amount of our cost of goods sold before the end of the year and before all of that is transferred to our final income statement. And finally, just a couple more journal entries to review. The first one is to record our sales. Remember, every sale requires 2 journal entries. This should be a review from your Accounting 101 course. First, we record that sale, and second, we record the cost of goods sold that goes along with that sale, and decreasing our finished goods that are available for sale.